Hey everyone, welcome back to Market Mamas. Thank you all for joining us. I'm Kendra and this is Becky, and we're day traders from the US. Becky is in the Pacific Northwest and I'm in Northern Cali. We both started trading in early 2021 and became trade accountability partners a couple months into our education, and now we're here with you all. Both Becky and I have traded stocks, commodities, options previously, but we're focusing now solely on day trading futures, and we use funded accounts for our capital. We decided to create this Market Mamas day trading psychology podcast to just share all of the growing pains and the inner workings that day traders experience. We have a great large library now with lots of episodes on various topics, must-read recommendation, and real trader interviews for you all to check out. We're always looking to be of service in helping and guiding developing traders and just spread awareness of this amazing opportunity. So Becky today is going to go ahead and talk about her favorite trading setup. So I'm super excited, and I'm pretty sure most of you have probably heard of it. So that's going to be the mean reversion. So take it away, Becky.
Yes, girl. It is time that I really just devote an entire episode here at Market Mamas to share my love for this technical trading topic. I mean, mean reversion opportunities in trading can happen very frequently. So for the US futures indices specifically, statistically, they will be range bound or rotational for up to 70% of the days. So it's during these conditions when it's consolidating that mean reversion can be a frequent opportunity. This can be observed and traded with a few different kind of tweaks on the system. There's some variability within it. That's the same general trade idea. There's techniques with this both early in the regular trading session hours and then also at the end of a day's session. So kind of some different options there. Early in the session, there could be a setup where the overnight session was rotational and we're opening within the previous day's value area. In that setup, if we are towards an extreme of a value area and potentially around the upper standard deviation bands, the two standard deviation bands on either the upper or the lower end, then there can often be a setup where the price will trade back towards the naked point of control or POC from the previous day's session. So this is an early session naked point of control setup as well as a mean reversion category of trade. And it's one of my very favorite. Kendra will know. I'll message her. I'll be like, I got my naked point of control, and like success, check, next. So it's not always like super obvious. And you definitely have to, it's not like a, slam dunk every time you just look sideways at it and you see it. But you definitely need to factor in all of your normal variables and your process as well before you take any trade, of course. But if it is the setup and you have studied it and traded it many times, you can kind of start to gain an intuitive feeling for it. The confluences will start to compound just prior to market open, and then the likelihood of early and quick success with the setup will become palpable as you study it. So for me, if I can start to see a divergence in the direction that I'm looking to trade and a fatigue in the candles along a 2 standard deviation band, the market condition was rotational and the naked point of control is within range of the value area that we're opening inside of, then I have to practice restraint and to honor my intended position size for my system and not just literally throw all of my leverage and the kitchen sink at these trades. Because this setup is one that I see the most clearly, and it's honestly pretty frequent. You know what I mean?
Oh, for sure. I love those trades back to the previous day POC. I'm so glad, Becky, you're talking about this on our show and just sharing. Like, you could tell how excited you get just talking about it, because it's like, this is what we do, like day in and day out, things we're looking for, some of our best setups. It's an exciting topic. So to kind of just add on to what Becky's saying. So for our viewers who aren't as versed in trading as we are, I mean, not that we're experts or anything, but a point of control is basically an area on our chart where previously day session, the most volume has been traded. And these areas, I mean, they act like magnets. I mean, they're liquidity zones, and they're usually, like Becky said, depending on where we're opening, they can be the closest reference points. So it totally makes sense for us to, when we have these opportunities, for us to just trust in them and trade to them. They're beautiful targets, and they're one of my favorite trades as well. So Becky, keep on telling us more.
Yeah, I mean, when you know what a setup can kind of look like and where a high likely target is, it's like once you start getting that understanding, you're like, I think that that's when you can understand that trading is a skill and not gambling. So this is a point that we have covered in another episode, but also like it's a bone of contention with the discussion of trading with people who don't understand it, because it's gambling. You're just throwing money. How do you even know if it's going to go up or down? And it's totally risky. But it's like this whole discussion today is a prime example of that there is an absolute scale because we have a logical understanding of a target and direction and a setup that it is. So side note, but it's beautiful. So more on mean reversion. So the core of a mean reversion trade, it revolves around the auction market theory and the understanding that the market functions by having buyers and sellers present and exchanging contracts or shares, depending on your market. So for every buy order, someone is on the other end of that trade and they took a short. There's give and take and push and pull within the market to make it move. And the large institutions with big orders, they will often need to take their time and have some patience with building a position and or liquidating one. So the consolidation periods occur as these phases of the market iron out who will remain in control of the greater direction. So what that feels like as a day trader is a solid initial directional move intraday followed by a period of exhaustion. And that exhaustion or consolidation could be accumulation or distribution. And that will be a setup for a temporary correction, often back to a point of previous support and resistance, such as a point of control where price has held for a considerable amount of time, to then test the greater intentions of the market and what happened when we broke from that level before. So where the market tops or bottoms out before bouncing back inward, that can be tricky to identify, and it's not to be taken lightly. So essentially with these opportunities, you are aiming to catch a turn in the market, catching a knife or catching the bottom, you know what I mean? So you do have to be cautious with this risk management and backtest the heck out of executing on the strategy so that you can rapidly and in real time identify what supports a mean reversion trade setup versus what is a fake out and is actually a potentially trending day or at least trending chunk of time. Because let me tell you from experience, when I have faked myself out with one of these setups in the past, that was not actually market fatigue for a pivot, but rather a flag in the heart of a continuation move, that can get dangerous in a hurry without appropriate protective stop management. So in those two potential scenarios, it's really important to have clearly pre-planned your risk management strategy and exit plan if we do not, in fact, revert back inward as the mean reversion setup would indicate. So often you can get a really great risk management, honestly, with these setups, because if you're basing your entry off of a doji or an engulfing candle within the consolidation pattern at your level of interest, and then you enter based on a pivot candle pattern and data at that area, well, that entry in itself, it tells you exactly where your protective stop needs to be placed and left at. Because from my personal experience, if you do not want a naked trade or a loose stop loss placement with these, you just don't. Because if it was a balancing pause moment within a directional move, you can get killed very quickly when she takes off in the opposite direction. But as I said, if it is a pivot and you're trading back inwards towards a mean target, then just respect that part of your setup, right? As well as your position size for your account. That also keeps you safe because it's within your risk tolerance. And then if your trade is wrong, right, then you will be all right with a smaller reasonable stop hit, because that's just the risk in order to take this trade. That's the risk of trading. And it's a part of our game. Like we really are, as traders, we are professional risk managers. And so to know that there's great setups that you can capitalize, you also have to respect the fact that what is your risk for that and understand that thoroughly before entering the trade for sure.
Yeah, definitely. We can always have our best intentions and our best logic behind the trade, but at the end of the day, we're risk managers first. So we're always here to say that, if nothing else. Yeah. We're trying to follow that every day really hard. But yeah, what I love about what Becky's highlighting today is that on these days, like there's really equal opportunities for buyers and sellers, which is really great. And there's so many different ways that you can observe and like study a rotational day and recognize it. So for me, I trade with market profile. And what's great about that is like as the day develops, you could literally see a value area. And what that means is that's a level or a zone really where 68.2% of all transactions throughout the day have been taking place. And even within that, you have, again, the volume point of control, which is showing where the most volume has taken place. And then you also have a TPO, which is a time price opportunity, where market has spent the most time during the day. What it looks like visually is a beautiful, most perfect textbook balanced day is going to look like a D shape. which I'll add to the B-roll. But it's just so gorgeous because you could literally see from there when market goes to one extreme end or the other, then there's going to be an initiative for either a buyer or sellers to respond at those levels. And as Becky said, that can give us the most low risk entries if you're around at that time and you really wait, for, price action and or order flow, whatever you use for your confluences.
Yeah, I hadn't even started talking about the end of day trade, girl, because that is a totally different subject. Well, not a different subject. It's a different part of mean reversion. So the early session mean reversions, you do have less data, like market profile and volume profile are excellent targets that excellent tools that I also use, especially at the end of day mean reversion trades. But early in the session, they are not helpful yet because we haven't even formed them for the day, right? Those are formed based on the early price action of a day. And as price moves, they are formed based on volume, price that was filled at, and the time when the market moved. And so towards the end of the day, those become your valuable resources for the second half of the mean reversion. But early in the day, it's based on the previous day's value areas and market profiles. And so it's an interesting evolution because right when New York session opens, you just don't have any market profile or volume profile information yet, but you do have recent days, which is a lot. In trading, when you learn, they say, look left. And what does that tell you? And that's where we get to the point of control and the high and low value area targets from the previous day to base your opening trade opportunities on. And then later in the day, oh my gosh, you guys, this trade literally happened mean reversion. There's a setup early based on previous day, and later, like Kendra just alluded to, with her market profile and volume profile, because as the day prints, that's when you learn what the day is. And rotational days early on can be kind of messy, but as they form, you're right, the beautiful bell curve really does tell you where buyers and sellers are fatiguing at, and those opportunities are sick. Let me spiel a little more. But a big factor with this strategy. So it's the exact location of the target or the mean. So the point of this that I want to caution you guys with is that it's really not a static point. So it's very variable based on the time of day, the type of market, range of the session, and the momentum or volume within that day. It can be identified as sometimes it's VWAP. It can be a recent day's previous point of control, such as the early setup for the previous day's naked point of control. It can be even 50% of a range that we are trading into, a daily range or a weekly range. It can even be a trend line on a gentle or slower directional day, because that also is the mean of the move that is happening that day. And that also can be categorized as a mean reversion trade because it's reverting to the mean of the move that we're in. So also applicable on trending days to an extent, as long as they're not those really high flying, super fast ones. Those do not have mean reversion setups, and don't even fool yourself. But as you can see, it actually really is a subjective location based on the day that you're having. So I have found that I do much better with taking profits on the conservative side. So for instance, if I'm aiming for VWAP or a naked point of control, then I will set my take profit a few points closer to my entry than the exact tick of the target. Because honestly, there's tremendous variability on these targets from platform to platform and depending on the time frame that the trader is focusing on. So if you're on a 15-minute and the VWAP on the 5, they're going to be slightly in a different position. And so you don't want to aim for a deepest one necessarily and have it not hit, because if many traders are aiming for the same target in a setup, millions, then they're also utilizing, a slightly earlier target to get the fill. If they're using that theory as well, the price could never directly tag a target, even though that was a trade setup and essentially it does play out. It could ping a couple points above. And if you are holding out for exact target, you could get screwed. Speaking from experience, it has happened. I have learned that it's a trigger for me to be in a really strong trade setup, such as one of these opportunities within my system. And then if my target doesn't get filled by a tiny distance, and then it reverses, I get so crabby, you guys. I'm like, I had it, in my head, right? I was likely counting on the win for the trade outcome as it was nearly hitting my target. And usually at that point, I'm standing, I'm okay, just tag it. And then you can start to see all those unrealized points just evaporating. That can really get to me. And so it makes me want to sometimes get a little crabby, potentially revenge, or just close the trade in general for a small win as it's pulled way the heck back. And then, there's a risk point there to potentially want to get back in the market, to get back the points that I was mentally counting in my daily P&L, counting them to be locked in when they weren't yet. So the risky behaviors can ensue from that. So for me, I now have precautions in place to avoid that because I have learned that that is a trigger for me. So I will lock in my trade target just before my target actually gets tagged. And often I can leave a runner for farther targets, but to take off the bulk of my position just prior to the highest likely target is kind of an excellent strategy, what I have found. And it can also, it does sting a little bit also because mean reversions can also be like just the move down, right? And so it can suck a little bit to see it fly through my target and then keep moving, right? So there's the risk of that outcome as well when you're like take off most of your position at your mean target and then it just keeps going. So then I can get frustrated at leaving so many points on the table when I had such a great entry. So, there's different ways that you have to be mentally prepared to respect it. But if I have my full size, I do want to try and respect the fact that I do not have to take all of a move to be nicely profitable, right? Like it's not the goal to take from the very tip to the very tip. That's not even reasonable or an appropriate respect of this game, right? And so with this setup, mean reversions, they have a target. The setup has a target, and I identify that before I get into my trade. And so I do want to honor my trade plan more. I want to honor it more than I need to take the entire move at this point in my career, But then one alternative to kind of more fully capitalize is to leave a runner to see what happens afterwards, and then you can just snug up your stop as it goes. So there's different ways to play it with the target.
Yeah, that's such a good topic too that you're bringing up because there's nothing worse than when your market goes a tick away from your target and you're like, damn, if I would have just been a little more flexible, a little more conservative. And I know for me, like I'm super slow. Like sometimes that happens and I know in the instant I should flatten, like if it got that close and rejected. And that's what happens a lot on these really tight rotational days. So it's a learning process for sure. It's always better to lock in some points and then, like you said, we never know what's going to happen. So it's great when you could secure your points and then just like move on. If you're not satisfied, just move on and be content. But I also want to bring up, I love what you talked about though, because when I first started learning auction theory, like one of the first parts of our lessons was understanding who you're trading with, like understand who's currently in the market. And anytime we are consolidating, on our daily time frames, when we are having these extreme balance days, like recognizing that there's scalpers in the market, there's day traders in the market, there's very short time participants that's moving the market right now. So we're only within the daily highs and lows within a value area. So those are great signals to really be like, okay, how do I need to manage my trade today? Whereas when we are trending and we do have these beautiful, like imbalanced moves, that is when the big boys are in. That is when long-term traders are in, institutional traders are moving the market. And that is when, especially if you have targets on your larger time frames, then you can really be like, all right, I need to hold to these targets. But it can be hard because the majority of the time we have to train ourselves to not expect that. So then when I know for Becky and I, then we do have those opportunities, then we kick ourselves in the butt sometimes because we're like, damn it, this was the day to hold to my target and not be conservative and not scalp. Why am I doing the opposite of what I should be doing? So it's interesting. And I also love what you said, how you can really look at mean reversion like so many different ways, like especially depending on your time frame as well. Like you can look at a weekly chart and you could see mean reversion playing out as well. One of the examples I remember was when we had that election week not too long ago where price, just gapped up and then built a ton of value for that week, right? And then eventually market fell. And then eventually she worked her way back up because we had, again, on a weekly time frame, we had that naked point of control. We had that liquidity zone. We had that value area the market wanted to make its way back to. So as Becky referenced in the beginning of the episode, we do really have so many tools to read and not be gambling, but understand, why the market's going where she's going. And on those type of days, when not only we have evidence from our daily chart, how we're opening, our price action, our conditions, but then we also have confluence on larger time frames. Those are like the best setups. And those are targets that you really do want to hold to and trust your analysis. So it's trading. I love trading. It's such an awesome discussion.
Well, like intraday, I mean, I love the point that you brought out that this is, applicable to all the time frames, because intraday we can be talking about a consolidation period on a 5-minute chart, and then we're taking the breakout of that, such as with the early naked point of control setup. That's usually an intraday value area situation. But if we really do break out of like a daily consolidation area, that's where you do aim for a weekly point of control potentially. And so that's when you can essentially be trading a mean reversion on like a weekly scale, but then be trading a trending day within that setup. And so it's all just, you have to put all this together in order to create like a frame and a contextual understanding of what she is doing, and then how you best can utilize it intraday, what your signals are sending you. And then, oh my God, Kendra, your point about getting in and you get out at the mean target and then she just freaking flies. Like I've had that interaction so many times because I really trade mean reversion all the time. And you get in and you're like, mother hecker, that was the top of the day that fell like 500 points. And I took like, 90 of the so that can sting, and that's something to study. And then often, but we can, as we grow as traders, we have had those experiences, right? And so in that situation, you can lock in your points, and then you could recognize, okay, this doesn't look like mean reversion anymore. This looks like trending. We are breaking supports. And so then you can also, look for a secondary setup, right? When it pulls up, and then you're like, okay, now I see there's ways to pivot and adjust as your data presents. And so taking a mean reversion trade early in the day and then recognizing that it doesn't hold as a rotational day can just provide more opportunity if you're someone who wants to trade throughout the day. And so an example of like having a setup and capitalize on it, but then recognizing that the market profile and volume profile are still figuring their life out. And so you have so much more data to gain within a day and figure it out. So the market is beautiful.
Yeah. And then sometimes you have double distribution days where then it's like everything's just confusing for a moment. You're like, what do you mean? We had this value area we were respecting, and now you're just going to go to a whole other zone? Like,
yeah, those days are interesting for sure. They are not as common at all as the other profile shapes, but they are very interesting, and they're fun too.
Yeah. And it just keeps us on our toes. Like, our job is to do our best to follow her. And sometimes she's like showing out for the day and we're just like, okay, didn't expect that move.
What do you think of this, guys?
Yeah. I'm in charge.
Right? Always. So in the last 3 years, I really focused my trading on the futures market, right? We've talked about what we have done in the past. And so specifically, I traded mostly the ES or S&P 500 and YM, the Dow Jones Industrial Average. So for my trading experience, nearly daily for a few years now, plus backtesting and learning from mentors, you learn over time that how your instrument moves. And I think that is just an edge in itself, right? Just the familiarity with your market. They each have certain energy and tendencies, repeatable patterns, and sort of vibe to them. So of course, there's variability and irregularities within this. It's not constant, but you can kind of learn her moves and get better at anticipating them and what they are setting up for with time and attention. That comes over time. And so for all our beginning traders out there that are watching this is not a thing that can be rushed. You have to just keep showing up and learning, watching, asking questions, and trading and feeling the outcomes of your trades. Every trade that you experience and you really pay attention to and you study that night and you journal about, it will teach you whether it's a win or a loss if you let it. And so the one thing that I have noticed about both ES and YM specifically is that at least a couple days a week, there will be a decent mean reversion setup, especially in the last hour and a half of the New York session. Even to some extent on her trending days, like such as potentially a B profile or double distribution at the end. And so that at least partially there's a psychological drive behind that and how she moves towards the end of a day. And so traders, often day traders, will want to lock in their profits for the day. And so if they have held a trade from one end of the day to nearly the end at the opposite side of the day's profile, we can surmise that potentially profit taking from traders who do not hold overnight may take place down there. I mean, day traders trade intraday and they generally do not hold a position overnight. So there's going to be some closing of positions that will cause the end of the day volatility that you can kind of study and see how that plays out. An exhaustion as well as a satisfaction from those traders that held most of the move during the day who have been in, then they want to be done and lock it in and then enjoy their evening. That's a part of being a day trader. And so if you notice on a daily chart, most candles have a wick on the top and the bottom, right? How do wicks form? They are the tip of a move in that observed time period, such as in a day, and then the price pulls back before that time frame closes, aka the end of that day for that daily candle. And so hence the wick on the daily candle is, at least in part, the size of her mean reversion before the market closes. So this is potentially a great setup for the end of my day. And that's why I start watching the market every day that I'm home and how she moves each day, because towards the end, there's potentially an awesome trade around the 11:30 or noon Pacific Standard Time opportunity, because she may be fatiguing and showing you signs that there's another divergence setting up, and she can revert back in to create the wick on that day. And so, as Kendra alluded earlier as well, the market profile and volume profile are mostly formed by then. They're 85% formed at that point, and they give you tremendous value in information, because the market will tell you things. Like, if you can stay focused with your data, especially towards the end of the day, there's so much information out there. And so this is definitely a setup that I have tried to capitalize quite a bit on over the past couple of years. It's really, in terms of mean reversion, a lot of people will think of, honestly, the end of the day setup as the gold standard in that, because it really is the end of a day. You have so much information on your profiles, and you can catch the settling back of price before it closes. And so that is like the quintessential mean reversion trade that I definitely also really appreciate.
Totally. Yeah. I love that you brought up how much value you can gain from how the day played out, especially on these days, on these rotational days, when the day looks very neutral on the profile. We have what's called a extreme. So if usually on these days, if market closes, we were very, very balanced, right, all day, and the market closes on one extreme or the other, market gives us clues. And that can be a very significant clue to how the next day is going to open, how the direction we're going to go. So there's all these things that we can study and back test and see. And then it just gives us more confidence, going into our next day, making our trade plans, and, just respecting, what she's showing us, what she's revealing to us.
Yeah, I feel like there's tremendous value from noting how a day closes and what maybe she was still intending to do, and what could potentially that allude to the next day. That's an excellent little side tidbit there on technical analysis, because the way a day ends does provide some interesting information for how the next day might play out, for sure.
And a lot of times what I've noticed, and I feel like this is like a part of my maturity too, is that like a lot of days I would go in with a plan and she failed to get my target, right? And then in the past, I would chase that all the rest of the freaking day, right? And now, instead of accepting like, okay, that was it, she's done, now we're going to be rotational, leave it alone, right? And then the next day, a lot of times, bam, like right away after opening, that happened to me last week. I was like, the previous day, I tried to hold for a higher target, and then it didn't happen. We ended up being rotational. I was like, whatever, I'm done with you today, market. And then I came into the next day, and literally, like, I don't know, I want to say within the first like 5 minutes or so, it went to that target. And then I was fresh, and then came into the next day, and we had much better conditions, like everything, rhythm for the market. It just happened. And I think that that's one of those things that we start to like understand and respect about her, is that timing is everything. And just because we have a beautiful target and it makes sense, like she has to do it on her own time. And our only job is to understand when that time is and accept when it isn't. And if we do that, then I feel like we do get rewarded, if we just are patient. And then, like I said, the next day, I mean, it's just like, wham, bam, thank you, ma'am. I was like, oh, that was a target I wanted yesterday, and I got it today. So I'm grateful for that.
I know. And in those moments, I feel like, okay, I do understand the way that the market moves. She just wants to do it when she wants to do it. But I feel like it's still satisfying, even if you don't end up taking a piece, or you take a small piece and it doesn't get there during your time that you have allotted to trade. It does it later in the session or overnight or the next day. So you can still find satisfaction as a developing trader to know that, shit, I do know how to read the market. I have some skills. I have some understanding. And so even if you don't take a piece, there's like, it's a non-monetary win, right? Of like, all right, I'm a growing trader, and that was a great setup, and I understand that target, so that's cool. It's good. In the past, so we've already talked about this a little bit, but I mentioned that I am less comfortable taking a piece out of a trending continuation day. And okay, so I swear, this is my situation. As the trend is marching up or down, the farther extended it becomes from its start in a session, the more uncomfortable I get and the less trusting of continuation I am. I feel like directional traders, they have to exhaust at some point, and I don't know, I don't want to be the one caught chasing them. Plus, where the heck are they going in such a hurry anyways? Like, seriously, sometimes they just grind along the 2 standard deviation band for like crazy long. Okay, so I know trend traders, right now you're literally shaking your head and making fun of me, which is fine, carry on. do your thing. I love a trending day for you. And you're not wrong, because follow the trend till it bends, right? That's one of the very first things that we all learn as well. Get on with your bad self. But joining a trend late, it makes sense to me as being risky. After the first major push has happened and it's still going at speed, I feel like I'm just chasing the train and I don't like it. I don't like it. It doesn't feel good to me. But then attempting to catch and fade the end of a trend, as I sometimes do, it's not less risky. I totally respect that. And I hear the point. It's a different risk, right? It's a different potential setup. As a trade setup, it's more appealing to me, but I do have to be very cautious with that. When you do think it's been a big run up into supply or run down into support, there is absolutely setups where that support or resistance holds and you can get the switch back up. I feel like that's almost more common than trending days. However, it's risky because there's been a huge push, and so you are going counter trend in that moment. But it's also a factor of, be greedy when others are fearful and be fearful when others are greedy. That's also a factor in this debate for me in my mind that I'm trying to, be very cognizant of and cautious with. And I think that all traders honestly are pretty variable on this topic, but generally in their souls, they prefer one trade setup over the other. And Kendra and I are kind of opposites on this. I really do love the mean reversion setup. And so I personally have to constantly, daily remain cognizant of this bias in me and be cautious, right? I watch carefully for my data to strongly support a setup, or I need to just not engage or attempt it in maybe sim if I am less sure, but I feel like I want to participate and see what she's going to do. In that situation, it's no longer an A+ setup because there's conflicting data. And so that doesn't necessarily mean that I need to put my capital on the line with that. I can still stay present with the market and learn from her, but not with all my accounts roped into it, right? So because I've absolutely lost in glorious fashion when I am sure that this is the setup, right? In that situation, if I'm overconfident, I can attach my bias to this situation and then potentially over leverage or be too loose with my stop in order to be right, or heaven forbid, like average the position because I'm just so confident, right? But those choices are not sustainable. Overconfidence like that can wipe a person out. So that being said, mean reversions, they really are a regular setup for me and routinely quite profitable. But nothing isn't always in trading, and respecting the game of risk is absolutely required to stay in this game. So I think it's a sign of growth and maturity as a trader that we are able to clearly identify what our A+ setups look like and then how to trade them. And we can do this while respecting the other opportunities in the market as options to study, practice, learn to love as well. So for me, obviously, I'm actively working to improve my trend trading each week as well, because there's absolutely the market trends, right? We've been in bullish trends since inception. And so there's definitely days when I need to more fully capitalize and respect that. And I can use my data to support a trending day and take opportunities on pullbacks. And I'm growing in that department. And so I think that the really beautiful part of trading is the endless potential if we are humble and open enough to learn all of the ways that she moves, not just the ones that are intuitive for us, right? Like mean reversion just calls to me from the chart. But the ones that are not as intuitive, I can still study my ass off on those and learn to capitalize on them. And so whichever way you go, you can work it.
Yeah, you can. And I love that whole spiel because it just really highlights the need for self-observation, because that's the only way we learn and the only way we grow is by understanding, okay, when market moves like this is how it makes me feel. This is what I've done in the past. And then now you can study that. It either hasn't been successful for me and I need to figure out a way to not keep falling for that, So I mean, it's just so interesting. Like we all have a different way of understanding and leaning into things and how we feel. I mean, we can't hide from our feelings. So when Becky and I interviewed Adrian from Australia, he really highlighted about the importance of our emotions and not running from them, but using them as a tool that we can study and figure out and back test and gain value from. So everyone, if you haven't checked out that episode, please do, because I feel like we talked a good while about the importance of our emotions and how they're not actually as harmful. They don't have to be as harmful as, they can be when we're first starting out and just not fully understanding ourselves or the market for that matter. So I really love that, Becky, you highlighted it. And it's just it's been a challenge for me too, because I mean, like you said, everyone sees things differently. So we're literally the opposite. Like I've had trades that I've sent Becky and she's like, oh my gosh, girl, like I can't believe you bought so high in those upper bands. Right, Becky? And you're like, that just looks like so risky and like scary to me. And I'm just like, girl, I saw this rhythm. And for some reason, when I see this, I just trust it. Like I see her going and I just believe she's going to keep going. But on the opposite horrible side of that for me is when she's not going to keep going and I see all this strong momentum push in one direction, it's so much harder for me to accept that it's over. It's over. We're reversing, we're rebounding, and she's going to fly in the opposite direction now. And I'm like, but no, like we just moved down or we just moved up so strong. Like clearly that's the direction. So it's just so insane to me how our minds think and how the individual like psychological like battles and breakthroughs and ways we have to kind of like iron out ourselves and our understanding and then go to work at, okay, how can I prevent myself from letting this bias, letting this natural way I see things like take over what's actually happening on the charts. So right. Like Becky said, just follow the trend till it bends and just at the end of the day, just follow what she's doing, not what we want her to do.
That's like the moral of the entire discussion of trading in general is like, just stay present and study and follow your technicals and let her lead and then take cues from that. Saves us.
Trade what you see, which I hate, but
it's such a gray general statement that means nothing, but also everything.
Yeah, we heard that so many times when we first started. Like, trade what you see, trade what you see. Like, I roll, like, whatever the hell. And now it's like all these years later, yeah, just freaking trade what you see, not what you want.
Now that we can see shit, we're like, oh yeah, that's what that means.
Okay, yeah.
Okay, so we kind of really got deep into all the versions, all the ways we could talk about meme reversions today, but it really is a very key setup that I just thoroughly love. So we want to know, who else loves a strong meme reversion trade? It's a very common trade opportunity, especially in the U.S. futures markets, and there are variations to it that we talked about today. So I know that there are many of us that thoroughly enjoy capitalizing on these, and maybe some of you that don't see them as intuitively. So please leave a comment. Tell us your experience on this topic. If you have a quick minute, we love hearing from you guys and comparing notes. Thank you all for being here with us today. We love talking about our favorite subject, trading, obviously. If you're still here at the end of this video, so do you. So keep at it, my fellow traders. And Miss Market, she is abundant for those of us that embrace a growth mindset and pursue deliberate practice in learning her tells and our own tendencies and observing ourselves throughout this journey. So please take a moment and subscribe if you haven't already. And thank you so much, everyone. Have a great day.
Thank you, everyone. Take care.